A prolonged slowing in the pace of improvement over time could trigger typical recessionary dynamics as weakness feeds on weakness. A long period of unnecessarily slow progress could continue to exacerbate existing disparities in our economy. That would be tragic, especially in light of our country's progress on these issues in the years leading up to the pandemic. The expansion is still far from complete. At this early stage, I would argue that the risks of policy intervention are still asymmetric. Too little support would lead to a weak recovery, creating unnecessary hardship for households and businesses. Over time, household insolvencies and business bankruptcies would rise, harming the productive capacity of the economy and holding back wage growth. In a typical recession, there is a downward spiral in which layoffs lead to still lower demand and subsequent additional layoffs. This dynamic was disrupted by the infusion of funds to households and businesses. Prompt and forceful policy actions were also likely responsible for reducing risk aversion in financial markets and business decisions more broadly. The burdens of the downturn have not been evenly shared. The initial job losses fell heavily on lower wage workers in service industries facing the public, job categories in which minorities and women are overrepresented. In August, employment of those in the bottom quartile of the wage distribution was still 21% below its February level, while it was only 4% lower for other workers. Combined with the disproportionate effects of COVID on communities of color and the overwhelming burden of childcare during quarantine and distance learning, which has fallen mostly on women, the pandemic is further widening divides in wealth and economic mobility. The fiscal response was truly extraordinary. The unanimous passage of the CARES Act and 3 other bills passed with broad support in March and April established wide-ranging programs that are expected to provide roughly $3 trillion in economic support overall, by far the largest and most innovative fiscal response to an economic crisis since the Great Depression. Still, since it appears that many will undergo extended periods of unemployment, there is likely to be a need for further support. Second, aid to firms, in particular the Paycheck Protection Program, and the general boost to aggregate demand have so far partly forestalled an expected wave of bankruptcies and lessened to permanent layoffs. Business investment appears to be on a renewed upward trajectory, and new business formation similarly appears to be rebounding, pointing to some confidence in the path ahead.